EPK Capital presents Daily Brief for 17 August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host, Sneha. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. The financial world today was a study in conflicted optimism. On one hand, the Dow Jones Industrial Average surged to a new intraday peak, a clear signal of bullish sentiment in some corners. On the other, a broader sense of caution prevailed, with technology stocks taking a step back and investors globally digesting a complex mix of economic signals. This is a market at a crossroads, weighing the promise of future growth against the stubborn realities of the present economy. Today we will dissect a mixed session on Wall Street, where the Dow touched a new peak while tech took a breather. We will dive deep into the crucial inflation data that is fueling the Federal Reserve's toughest debate yet. Then, we will shift to the world stage to analyze a major statement on the path to peace in Ukraine. And finally, we will navigate the crypto markets, where a significant pullback is telling a story not just about digital assets, but about the entire global economic picture. Let's begin. The closing bell, a global market snapshot. The trading day concluded with a fractured performance across major U.S. indices, suggesting that the powerful rally of recent weeks is pausing for breath as investors reassess the path forward. In New York, the session was a tale of two markets. The Dow Jones Industrial Average managed to climb by 34.86 points, a modest gain of 0.08%, to close the session at 44,946.12. Notably, during the trading day, the blue-chip index surged to its first all-time intraday high since December before paring those gains, a move heavily influenced by a single component stock which we will explore later. In contrast, the broader market showed signs of fatigue. The benchmark S&P 500 shed 0.3% to close at 6,449.80, pulling back from the record highs it had set in the three preceding sessions. This break in its upward streak signals a moment of consolidation. The technology sector felt the most significant pressure. The tech-heavy NASDAQ composite declined by 0.4%, with its closing value settling around 21,710.67. This weakness was largely attributable to specific headwinds within the semiconductor industry, highlighting a key theme of the day. Market movements were being driven by specific, targeted factors rather than a single, overarching sentiment. A closer look at the session reveals a significant divergence beneath the surface. The Dow's strength was not indicative of broad market health, but was instead propelled by a single, non-tech component, while the technology-centric NASDAQ faltered under sector-specific pressures. This indicates a rotational market where investors are becoming more selective, favoring specific narratives over broad, risk-on exposure. European markets also closed with a mixed picture, reflecting the cautious tone from the U.S. In the United Kingdom, the FTSE 100 closed down, settling at 9,138.90, in a slight retreat that was part of the broader global consolidation. Germany's DAX, however, showed more resilience, posting a marginal gain for the day. Meanwhile, France's CAC 40 was a notable outperformer, posting a solid gain of 0.54% to close at 7,147.17. Trading in Asia was heavily influenced by regional economic data. Japan's Nikkei 225 continued its strong performance, rallying to close at 43,378.31. In Hong Kong, the market reacted directly to news from the mainland. The Hang Seng Index fell 0.98% to 25,270.07, a decline explicitly linked to weaker-than-expected economic data released from China. This underscores the high sensitivity of the Hong Kong market to the health of the mainland economy. Conversely, Indian markets showed renewed investor confidence, Both the BSE Sensex and the Nifty 50 broke their recent losing streaks. The Sensex added 739.87 points, a gain of 0.92%, to settle at 8,597.66, while the Nifty 50 gained 268 points, or 1.10%, to close at 24,631. The economic engine, inflation, growth, and the Fed's next move. The primary driver of market sentiment this week has been the flow of macroeconomic data, particularly the latest readings on inflation, which are forcing a difficult conversation at the U.S. Federal Reserve. The July Consumer Price Index, CPI, report, released on August 12th, presented a nuanced and challenging picture for policymakers. On the surface, headline inflation appeared contained, holding steady year over year at 2.7%. This figure was aided significantly by a 1.55% annual decline in energy prices. On a month-over-month basis, the headline index rose a moderate 0.2%. However, the real story for the market and the Federal Reserve lies within the core inflation numbers. Core CPI, which strips out volatile food and energy prices to provide a clearer view of underlying trends, accelerated to 3.1% on a year-over-year basis. This is its highest level since February, and a signal of persistent, sticky inflation that complicates the central bank's policy path. The monthly core CPI reading also rose by a sharper 0.32%, further underscoring this trend. This dynamic has revived the good news is bad news paradox for markets. The initial positive reaction to the seemingly benign headline inflation number was a superficial one. A deeper analysis reveals that the details of the report, specifically the acceleration in core inflation, are actually negative for the rate cut narrative that has been fueling the recent market rally. The Federal Reserve's mandate is price stability, and core inflation is the superior indicator of underlying price pressures. A rising core makes it exceptionally difficult for the Fed to justify the dovish policy pivot that the market has already begun to price in. This creates a fragile foundation for equity valuations, setting the stage for potential disappointment and volatility when the central bank is forced to address this reality. This inflation data feeds directly into the Federal Reserve's policy dilemma. The market's recent strength has been built on the hope that the Fed will soon begin cutting interest rates. The stickiness in core inflation, however, makes such a move problematic. This tension is reflected within the Federal Open Market Committee, FOMC, itself. In a recent speech, Fed Governor Michelle Bowman revealed that she dissented at the last meeting, arguing that a rate cut was necessary to proactively hedge against a weakening labor market. The official statement from the July FOMC meeting, where the committee held rates steady in a range of 4.25% to 4.5%, also noted that Governor Christopher Waller preferred a rate cut, indicating a growing internal debate. The central bank is now caught in a classic bind, forced to choose between two opposing risks, stimulating a potentially slowing job market or fighting a resurgence in inflation. All eyes now turn to the upcoming Jackson Hole Economic Symposium, a major gathering of global central bankers. The market will be listening intently to Fed Chair Jerome Powell's speech for any clarity on how the Fed intends to navigate this delicate balancing act. The U.S. is not operating in a vacuum. In the Eurozone, the July inflation rate was stable at 2.0% annually, right on the European Central Bank's target. However, a look at the components reveals a similar dynamic to the U.S., with rising food prices of 3.3% being offset by falling energy prices of 2.5%. A more significant global story is developing in China. Recently released economic data for July from China's National Bureau of Statistics painted a concerning picture of weakening domestic demand. While industrial production grew by a respectable 5.7%, other indicators flashed warning signs. The most acute concern remains the property sector, where investment in real estate development plummeted by 12.0% in the first 7 months of the year. This weakness is feeding into the broader economy, with consumer prices flat year over year and producer prices falling by 3.6%. These deflationary pressures are a clear signal of a domestic slowdown and were the direct cause of the Hang Seng Index's underperformance. China's economic situation is creating complex crosscurrents for the global economy. As the world's factory, China's falling producer prices mean it is exporting goods deflation to the West, which helps central banks in their fight against inflation. However, the root cause of this deflation, a severe domestic slowdown, also means China's demand for global commodities and finished products is waning, acting as a significant drag on global growth. This dual impact, simultaneously helping on the inflation front while hurting on the growth front, complicates the macroeconomic picture for policymakers worldwide and reinforces the International Monetary Fund's recent description of the global economy as demonstrating tenuous resilience amid persistent uncertainty. Corporate Corner: the stories driving the ticker. Beneath the surface of the broad market indices, the day's trading was defined by highly specific, company-level stories that drove significant price movements. This reinforces the idea that the market is currently rewarding deep, fundamental research over broad, thematic investing. The airline industry was a clear winner. Shares of United Airlines, UAL, jumped an impressive 10.2%, while Delta Airlines, DAL, gained 9.2%. This surge was not driven by general economic optimism, but was a direct reaction to a specific data point within the CPI report. Airfares rose 4% last month, breaking a prolonged streak of declines and signaling renewed pricing power for the carriers. However, this industry-wide tailwind could not save every participant. In a starkly contrasting story, Spirit Aviation Holdings, EFLYY, saw its shares plunge by more than 40% after the company issued a warning that it may be unable to continue operations due to an insufficient cash supply. This serves as a potent reminder that even in a favorable industry environment, severe company-specific operational and financial issues can be overwhelming. The semiconductor sector, a key driver of the Nasdaq's performance, came under significant pressure. Applied Materials, AMAT, plunged 14% after issuing a disappointing forward-looking outlook. This negative sentiment created a ripple effect, dragging down peers like KLA Corp, KLAC, which dropped 8%, and Lam Research LRCX, which slid 7%. Bucking this powerful downtrend was Intel, INTC, whose shares jumped nearly 3%. Intel's outperformance was due to company-specific factors, including reports that the Trump administration is considering tariff exemptions that would benefit the company, as well as continued investor confidence in the strategic turnaround being implemented by its new CEO. Despite the weakness in semiconductors, mega-cap technology stocks showed broad strength, helping to support the S&P 500. Shares of Meta Platforms, Broadcom, Microsoft, Apple, and Alphabet all closed higher for the day. In the entertainment sector, the newly combined Paramount Skydance, PSKY, saw its stock surge 8.4%. This rally was interpreted by the market as a vote of confidence in the new management team's aggressive content strategy. The move follows the company's recent announcement of a massive $7.7 billion deal to acquire the exclusive broadcasting rights for the Ultimate Fighting Championship, UFC, signaling a new era of significant investment in premium content. One of the day's biggest stories came from the healthcare sector, where shares of Insurer United Health, UNH, surged 12%. This powerful move was not tied to any fundamental news from the company or a broad trend in the healthcare industry. Instead, it was a direct result of a regulatory filing revealing that Warren Buffett's Berkshire Hathaway had taken a new stake in the company. This event serves as a classic case study on the immense power of sentiment driven by influential whale investors to move markets, particularly for a major Dow component. The geopolitical arena, diplomacy and market implications. On the world stage, a significant diplomatic development unfolded concerning the Russia-Ukraine conflict, with carefully worded statements from Western leaders signaling a potential shift in the path toward a resolution. On August 16th, UK Prime Minister Keir Starmer issued a formal statement that captured the delicate balance of current international diplomacy. The statement began by commending the efforts of U.S. President Donald Trump to end the war, using language such as having brought us closer than ever before to a resolution, and that his leadership should be commended. However, the message immediately pivoted to establish clear conditions for any path forward. It stressed that the next step must be further talks involving President Zelensky, making it clear that a lasting peace cannot be decided without direct Ukrainian participation. The statement also welcomed the expressed willingness of the United States and European partners to provide robust security guarantees to Ukraine as a core component of any potential deal. Finally, it concluded with a firm reaffirmation that sanctions will continue to tighten the screws on Russia's war machine until its assault stops. This nuanced position is shared by other key European leaders, including those from France and Germany, who have also called for a three-way summit involving Ukraine and have insisted on maintaining economic pressure on Russia. This diplomatic maneuvering can be seen as a managed de-risking exercise for financial markets. The headline suggesting peace talks could, in isolation, cause a volatile reaction, potentially leading to a sharp drop in oil prices or a sell-off in defense stocks. However, by immediately following up with a list of firm conditions, the inclusion of President Zelensky, the necessity of security guarantees, and the continuation of sanctions, Western leaders are adding crucial context. This signals to the market that any resolution will be slow, deliberate, and on terms acceptable to Ukraine and its allies. It introduces the possibility of a positive long-term outcome without creating the volatility that would come from a perceived capitulation or a sudden, disorderly end to the conflict. For markets, this is a message of cautious optimism rather than imminent resolution, providing a floor for sentiment while preventing a premature overreaction. The crypto frontier, a pullback and a regulatory dawn. The cryptocurrency market is currently experiencing a fascinating and pivotal moment, defined by two powerful and seemingly contradictory narratives unfolding simultaneously. In the short term, the crypto market is trading in lockstep with traditional risk assets. Bitcoin, BTC, has retreated from its recent all-time high of over $124,000 to a current level of around $117,000. The CoinDesk Bitcoin Price Index closed the previous session at $116,983, 48.33. Similarly, Ethereum, ETH, has pulled back to a range of approximately $4,410 to $4,450, down from its recent highs near $4,800. This pullback is not occurring in a vacuum. It is directly linked to the macroeconomic discussion. The diminishing odds of a near-term Federal Reserve interest rate cut, a consequence of the sticky core inflation data, have reduced investor appetite for high-risk, long-duration assets, and cryptocurrencies are currently behaving as the quintessential example of this asset class. This cooling sentiment is also visible in capital flows, with U.S. spot Ethereum ETFs recently experiencing net outflows of $59.34 million, breaking a recent streak of inflows. Despite the price pullback, signs of the industry's push toward mainstream finance continue. The cryptocurrency exchange Gemini has confidentially filed for an initial public offering, IPO, on the Nasdaq under the ticker symbol GIMI, selecting major investment banks like Goldman Sachs and Morgan Stanley as lead bookrunners for the deal. While the short-term price action is dictated by macro liquidity, a far more significant long-term structural change is underway. The United States is actively building a comprehensive regulatory foundation for the digital asset industry, resting on two main pillars. The first pillar is the Genius Act, recently signed into law by President Trump. This landmark legislation creates the first-ever comprehensive federal regulatory framework for stablecoins. Its key provisions are designed to build trust and safety in this crucial corner of the crypto ecosystem, The act mandates that stablecoin issuers must hold 100% of their reserves in high-quality liquid assets, such as cash or short-term U.S. Treasury securities, ensuring a 1.1 backing for every stablecoin issued. It also requires regular public audits and disclosures of these reserves and establishes critical consumer protections, giving stablecoin holders priority over other creditors in the event of an issuer's bankruptcy. The stated goal of the act is to make America a leader in digital assets by providing the regulatory clarity necessary for responsible innovation. The second pillar is the Securities and Exchange Commission's newly announced Project Crypto. This forward-looking initiative, led by SEC Chair Paul Atkins, aims to modernize existing securities laws to enable America's financial markets to move on-chain. The project has several key objectives: to create clear, bright-line rules to help market participants determine whether a specific crypto asset is a security, to establish a safe and workable framework for new token launches within the United States, and to provide innovation exemptions that would allow novel technologies and business models to come to market without being unduly stifled by regulations designed for a different era. This confluence of events is creating a great bifurcation in the crypto market. In the short term, its price action is becoming increasingly correlated with traditional finance, behaving like a speculative tech stock that is highly sensitive to Federal Reserve policy and macro liquidity conditions. At the very same time, its long-term underlying structure is being rebuilt by landmark regulation to be safer, more transparent, and ready for institutional-grade capital. An investor who only looks at the daily price charts sees a volatile risk-on asset. An investor who only looks at the regulatory news sees a massive long-term bullish catalyst. The most complete view recognizes both realities at once. The crypto space is maturing by becoming more sensitive to the traditional economic environment while simultaneously building the regulatory rails that will eventually allow it to grow on its own terms, attracting a new wave of institutional adoption. Conclusion: synthesizing the day and looking ahead. So, what did we learn today? First, that the stock market is running on specific stories, not just broad sentiment, with record highs in one index being offset by weakness in another. This is a selective environment that rewards a deep understanding of individual company catalysts. Second, that sticky core inflation is the key economic number to watch. It is creating a major dilemma for a Federal Reserve that the market has been expecting to turn dovish, setting the stage for potential policy disappointment. Third, that global diplomacy is a delicate dance of managing expectations. The carefully choreographed statements on Ukraine are designed to explore peace without creating undue market volatility. And finally, that the crypto market is living a double life, trading like a tech stock in the short term in response to macro data, while simultaneously building the institutional-grade regulatory foundation for its future. We hope this video was informative. If you think it did, then please do like and share the video. Also, do subscribe to our channel for such wonderful daily content. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.